Hello to everyone. Imagine the United States government as a friendly neighbor who's really good at borrowing a cup of sugar. But instead of sugar, they borrow money by selling bonds and treasury bills. That's U.S. debt. People all over the world, from everyday Americans to other countries, buy them because they're seen as the safest bet on the planet. Now, picture a strange day when, for the first time, no one shows up to buy them. What then? First, let's remember, this is a very unlikely what if. It's not about a minor dip in demand, but a complete stop. That said, exploring it helps us appreciate how the financial system works. If that day ever came, the immediate problem would be like a family running out of cash right before payday. The U.S. government uses borrowed money to pay for everything from Social Security and military salaries to road repairs and scientific research. Without new borrowing, it would have to rely only on tax revenue, which isn't enough to cover all its bills. The government would face an immediate and stark choice: abruptly slash spending by huge amounts or temporarily delay payments. This could mean missed checks to millions, halted contracts, and a sudden break on the economy. But the ripple effects would be even bigger. U.S. Treasury bonds are the bedrock of the global financial system. They're the risk-free asset against which all other risk is measured. Banks use them as collateral for loans, countries hold them as reliable savings, and they're the ultimate safe haven in a crisis. If that bedrock cracked, global confidence would shudder. Interest rates would skyrocket because the government would have to offer enormous incentives to try and attract any buyers. This would make mortgages, car loans, and business credit prohibitively expensive. The dollar, which is the world's primary reserve currency, largely because of this debt market, would likely plummet in value. This would make everything we import, from electronics to groceries, much more expensive, fueling inflation. In short, it wouldn't be a quiet financial event. It would be a severe global economic crisis, potentially worse than anything we've seen. Now, let's take a deep breath. Why is this scenario so improbable? Because U.S. debt is still considered the most secure and liquid asset in the world. The real question isn't about a total stop, but about what happens if demand softens over time. In that more plausible scenario, we'd see a gradual rise in borrowing costs, forcing tough but manageable conversations about budgets and priorities. So the ultimate answer to what happens is this: it would be a profound failure of confidence, not just in the U.S. government's finances, but in the central pillar of the entire global economic system. It's a reminder that this mechanism of borrowing is built on a foundation of trust. Trust in America's stability, its economy, and its political system. The takeaway isn't fear, but perspective. It highlights why responsible fiscal policy, political cooperation, and long-term planning are so crucial. They're not just abstract debates, they're the maintenance work on that bedrock, ensuring our friendly neighbor can always borrow that cup of sugar, keeping the lights on, the roads paved, and the global economy on steady ground. So, while it's a fascinating thought experiment, the most likely future is one where the U.S. continues to sell its debt. The real challenge is ensuring we do so in a way that keeps the trust and the system strong for generations to come. Thanks for watching.